All right, let's dive into something that's, well, a real cornerstone of finance: portfolio management. If you've ever found yourself wondering how you can make smarter, better investment decisions, this is for you. Learning how to build and manage a portfolio, it's honestly one of the most crucial skills out there. So, let's get right into it.
When you really think about it, every single investment decision, everyone, it all comes down to this one big question. We all want the highest possible return, right? But we also want to be able to sleep at night, not tossing and turning, worried we're going to lose it all. So, what's the secret? How do you strike that perfect balance between risk and reward?
And for ages, the go-to answer has been that classic saying. You've heard it a million times. It just makes sense, doesn't it? It feels right, and honestly, it's the foundation for everything we're about to unpack today. But, and this is a big but, there's a whole lot more science to it than just that simple phrase. Okay, so that old saying, the one about the eggs in the baskets, that is basically the heart of a really powerful idea in finance: the portfolio. Let's dig in and see how this super simple idea blossoms into a pretty sophisticated strategy for managing your money. So, what even is a portfolio? Well, at its most basic, it's just a collection of different investments. Think stocks, bonds, maybe some real estate, whatever, all bundled together. And the whole point, the entire reason we do this, is to lower our overall risk. The goal, of course, is to do that without giving up too much of those potential gains. Okay, but this is where things get interesting. This is where we go from that old school wisdom to some real financial science. Because you gotta ask, is just buying a bunch of different stuff enough? Like, if you go out and buy shares in 10 different tech companies, are you actually diversified? The answer might surprise you. It's a big no. We've got to be smarter about it. And that leads us right to this guy, the brilliant Harry Markowitz. He's basically the father of what we call modern portfolio theory. His idea was a complete game changer. He said, look, the risk of one single investment, it doesn't really matter on its own. What really matters is how it changes the risk of your entire portfolio. It's not just about what you own, it's about how all those pieces you own play together. All right, so if we're going to build a portfolio that actually works, we first have to understand the thing we're trying to manage, which is risk. But here's the twist. It turns out not all risk is the same. There are actually two very different kinds, and we really need to know the difference. So in the world of finance, risk isn't just a vague feeling of danger. It means something very specific. It's all about uncertainty, the chance that the return you actually get isn't the one you were hoping for. So think about it. The more a stock's price bounces around, up and down, the riskier it is. A government bond? Super stable, low risk. A hot new tech startup? All over the place, high risk. Makes sense, right? Okay, lean in for this one, because this is probably the most important idea we're going to cover. All investment risk, all of it, can be sorted into two main buckets. First, there's systematic risk. Think of this as the weather. It affects everyone. We're talking about things like recessions, interest rate hikes, stuff that hits the entire market. Then you have unsystematic risk. This is more like a problem at one specific farm. A factory fire, a bad CEO, a product recall. It only affects that one company or maybe its industry. And this, right here, is the real magic of diversification. You can't do anything about that systematic, market-wide risk. You can't stop a recession. But that unsystematic, company-specific risk, that you can control. In fact, you can almost completely wipe it out. When you have a properly diversified portfolio, the bad news from one company just gets drowned out by the good news from another. It's like your eggs are suddenly immune to any one basket breaking. Okay, so let's follow that thought. If diversification gets rid of that company-specific risk, what are we left with? Well, we're left with the market risk, the systematic stuff. And here's the key. That's the risk you're actually supposed to get paid for taking. So the next logical question is, how do we measure it? And how do we know what the right price or return is for taking on that risk? Yeah, this is the million-dollar question for any investor, really. If we have to face this market-wide risk, we'd better have a way to measure it, right? We need a number, some kind of yardstick that tells us, hey, how much does this particular stock get tossed around when the whole market moves? And that number has a name. It's called beta. The easiest way to think about beta is like a risk speedometer for a stock. It literally tells you how much a stock's price is expected to jump or fall for every 1% move in the overall market. It is without a doubt the most important measure we have for that systematic risk. So how does it work?
Well, everything is measured against a baseline. The market itself has a beta of exactly 1.0. That's our starting point. So, if a stock has a beta of 1, it's expected to move pretty much perfectly in sync with the market. Market's up 10%, the stock should be up around 10%. It just rides the wave, moving in lockstep. Now, what if a stock has a beta that's greater than 1? Well, that means it's riskier than the market average. Let's say it has a beta of 1.5. That means it tends to amplify the market's moves. So if the market has a great day and goes up 10%, this stock might jump 15%. Awesome, right? But, and you knew there was a but, it works both ways. If the market drops 10%, that stock could plummet 15%. Higher highs, but also lower lows. And then you've got the other side of the coin, stocks with a beta of less than 1. These are less volatile, safer than the market. A perfect example is a big, stable utility company. Its beta might be something like 0.6. Why? Because people need to turn on the lights whether the economy is booming or busting, right? Its business is just less connected to the overall economic cycle. So if the market tanks and drops 10%, this stock might only dip 6%. It's a much smoother ride, but the trade-off is you probably won't get those huge gains when the market is soaring. Okay, so we've got this awesome tool, Beta, that measures risk. Now what? What do we do with it? Well, that's where something called the Capital Asset Pricing Model, or just CAPM for short, comes into play. It's a really elegant idea. You basically start with the safest return you can get, like from a government bond. To that, you add the extra reward the market gives you just for being in the market at all. And then, here's the magic. You use beta to scale that extra reward up or down based on your specific stock's risk. What you end up with is the return you should, theoretically, expect to get for taking on that exact amount of risk. All right, quick recap. We've defined portfolios, we've dissected risk into 2 types, we even learned how to measure that risk with beta. So now it's time for the final piece of the puzzle, putting all of this together to figure out if a portfolio is actually any good. And one of the absolute best tools for the job is called the Sharpe Ratio. For just a minute, I want you to completely forget about how much money a portfolio made. The Sharpe Ratio answers a much smarter question. How much return did you get for the amount of risk you took? It's basically the ultimate bang for your buck score in investing. And the rule is simple. A higher Sharpe ratio is always, always better. Let's look at this example because it makes it so clear. You've got portfolio A, which pulled in a huge 30% return. Looks great, right? But hold on. Look at its risk level, that standard deviation number. It was all over the place, a super bumpy ride. Now look at portfolio B. It earns less, sure, but with way, way less risk. So when we do the math and calculate the Sharpe ratio, the metric that actually balances risk and reward, portfolio B is the clear winner. It was just a much smarter, more efficient way to invest. So I want to leave you with this one thought. The next time someone comes up to you all excited telling you about some amazing investment that made 15% last year, you're now armed with a much, much smarter question. You won't just say, wow, how much did it make? You'll look them in the eye and ask, yeah, but at what risk? Because now you get it. Return all by itself is only half the picture. And understanding both sides of that coin, that, right there, is the key to mastering your own financial future.